Hi, this is Matt Bloomfield. I'm a partner and portfolio manager for the bank loan business at Palmer Square. Wanted to just give a brief update on what we've been seeing in the past several quarters in the bank loan sector and kind of what our view is going forward as we head into the latter half of 2019. We were very active in the fourth quarter of 2018 and first quarter of 2019. And, really what we saw at that point in time was, significant volatility across asset classes. The loan market was no exception. As we thought about where we were headed into year end, we really saw one of two outcomes. One being maybe we're heading into a recession, and it makes sense to be up in quality if that would be the case. The second was more of a technical view, and that thoughts of being potentially coming back into the new year with capital ready to be put to work. In the loan market, the most likely place to be would be higher up in quality in double B type loans. And so we looked at the difference between double Bs and single B loans at that point in time, really at the beginning of December of 2018. And on a dollar price basis, they were really right on top of each other, which when you look back on a historical basis in times of volatility, you'll usually see quite a bit of price dispersion amongst single B and double Bs. So we aggressively traded the portfolio around several $100 million of trades in December alone to really shift the portfolios up in quality and take advantage of that unique period in time. As we moved into 2019, January and February, there were still a bunch of interesting opportunities to take advantage of, similar to December. But you really started to see, a rally across asset classes and credit in general. And double Bs and single B loans, performed quite well. As we've moved throughout the year, we've seen a bit of a more typical movement in prices, and double B loans have had significant bids and have rallied quite a bit. Right now, really looking at double B loans in the kind of high 99s to low par range, whereas single B loans really in the past month or so have begun to drift off a bit. And so as we look across on a relative value basis, we are seeing quite a bit of opportunity in the secondary loan market, more specifically in some of the higher quality single B type loans that on a pure dollar price basis in kind of the 96, 97 price context, look pretty attractive vis-a-vis some of the double B loans that are now trading north of par and basically, at a negative yield to call basis. From an outlook standpoint, we've been pretty active in the secondary market throughout most of this year. And I think, as we look forward, there's still a lot of great opportunities to be had in the secondary loan market. On the primary side, we haven't been doing much at all in 2019. We've probably participated in less than 20% of the new issue loans. And that's a function of credit quality. There's been significant amounts of leverage on a lot of these new transactions, a lot of adjustments going on through the earnings, and it's just difficult to get comfortable with the risk and the risk-adjusted returns from some of these primary deals. And another interesting aspect is, given the rates move over the past year, there's been significant outflows in the retail loan market. And really 40 plus straight weeks of outflows. It's really put a cap on dollar prices of secondary loans. And so we think from loans that we've underwritten and been monitoring for quite some time, I think there's some pretty attractive levels out there. And so I think as we move on into the latter half of this year, I think you'll see us be more active on higher quality secondary loans than in the primary. Post Labor Day, we are starting to see a significant calendar build on the primary. So, opportunistically take a look at what's available there. But overall are pretty constructive on our positioning. From an overall portfolio positioning standpoint, we're probably the most conservatively positioned we have been in some time, and that's across our CLOs and across some of our funds that have loan exposure. And I think our view is that we're going to continue to see more volatility going forward, and we want to have the portfolios positioned in a defensive manner to be able to take advantage of that again, just like we did in the fourth quarter of 2018 and first quarter of 2019.